Good afternoon, you're watching Bloomberg Quint Live and I'm Alex Matthew. Here are the headlines. Both benchmark indices trade with marginal gains. Broader markets outperform. Pharma stocks gain in trade today. Sun Pharma, Dr. Reddy's and Lupin are among the top nifty gainers. Crude prices touch a two-year high after a burst pipeline in Libya disrupts supply to the country's largest export terminal. And Jairam Thakur will be sworn in as the Chief Minister of Himachal Pradesh in a ceremony later today. And with that, it's over to Pradeep Pandya for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all these stocks buzzing in trade. So if you have been talking about or thinking of investing into one of these stocks that we have picked up as we do every day, 4 or 5 mid-cap stocks in which everybody is interested, some kind of news flows are driving it, or some anticipation of a news flow might be driving it. We'll talk about few such stocks today and take a view from both of our experts and tell you whether or not this is the right time to get into these stocks. Mid-cap space is in fact buzzing, so we have picked up a few stocks from mid-cap space, mainly from auto ancillary. You'll have infrastructure and other such buzzing sectors. But before we go to our experts and take a view on some of these stocks, let's discuss a stock which has given exponential gains in 2017. So as the year is coming to an end, we are trying to identify some such stocks, and our special series multi-baggers of 2017. In that today we feature Himadri Specialty Chemicals. Yatin Vota is standing by to tell us what the company is all about and what's driving its stellar rally. Yatin.
Thanks for that, Pradeep. And Himadri Specialty Chemicals, and that stock is up nearly 5 times in 2017, the calendar year which has gone by. And let me take you to the company, what the company exactly does. If you look at the company's product portfolio, coal tar pitch, SNF, carbon black, these are 3 main products which are manufactured by the company. And most of their company's revenue comes in from coal tar pitch, which is a very substantial portion of their revenues, which is used by the aluminum industry. Coming to the next slide, and you could see how really does the revenue breakup shape up for the company. So nearly 53%, I was mentioning earlier, majority of that comes in from coal tar pitch, and remainder comes in from these 3 business verticals, which is basically SNF, carbon black and power supply. Apart from that, if you look at the company's performance in FY 16-17 and first half, you could see that the company has seen a turnaround. So from a negative EPS of 0.4, they've already done an EPS of 2.4 in the first half of this financial year, almost replicating the performance of what they've done in FY 17. And you could see a steady growth in the revenues as well. And more importantly, the margins also have seen expansion from a level of 13.3% in FY 16 to a level of 22% in this financial year. Of course, the business is quite cyclical, but the demand for the products from the aluminum industry and the metals industry has surged, because of which the company has been able to improve profitability, product pricing and product volume. Not only the profitability, but the balance sheet parameters are also improved. So we have the debt to equity ratio of the company dropping significantly from a level of 1 time, nearly 0.6 times. So the kind of cash the company had generated in the last 2 financial years, bulk of that has gone into debt repayment. Coming to the next slide, what's working, and you could have 2 slides on what's working for the company. Number 1, improving aluminum and graphite market, because of which the company benefits. There is an anti-dumping duty on carbon black from China, and also rising contribution of high margin carbon black is something which has kept the profitability higher for the company. Coming to the next slide, and we have a couple of more points there. We have the volumes of the company which has improved. Capacity utilization from a level of sub 50% has improved from to a level of 61% there, so steady improvement on the operating matrix as well. And you could see the kind of blended EBITDA per ton, which was close to 4,500 rupees per ton in FY 15, that has moved to a level of almost 7,000 rupees in FY 17. So strong improvement in blended EBITDA per ton is what we have seen. Raw material costs have fallen, selling prices increased. So on an overall basis, the company has gained on all of these fronts. Of course, these are the return ratios. On the price to earnings front, of course, the share is quite expensive on FY 18 basis, 34 times, not cheap, but probably the market is anticipating that the pricing and the volume trend for the company will continue, which will improve substantial amount of earnings moving forward. And finally, we have the big risks that one investor needs to know. is the volatility in aluminum demand, which can impact the company's financials. More importantly, volatility in carbon black and coal tar pitch pricing is something that can impact the company's profitability. Removal of anti-dumping duty and foreign exchange fluctuations is something which can be a big risk for the earnings for Himadri Chemicals. So that is the stellar rally that we are talking about for Himadri Specialty Chemicals, nearly 5 times up in the last 12 months.
Thanks, Yatin, for the update. So, 5 baggers, so to say, Himadri Chemicals in 2017. Let's welcome our experts then, Sameer Kalra of Target Investing and also Amit Mantri of 2.2 Capital joins us on the show today. Welcome both of you. Any views on Himadri, by the way, before we start?
Not tracked it that much, so I don't have any.
Okay, so let's start our show with the list that we had picked up earlier. Today on Hot Money, we'll be discussing Minda Corporation, JP Associates, All Cargo Logistics and Syndicate Banks. And after that, experts will also give their picks on industrial space, a stock that they like in that space. Will take that pick also. But first, the stock on our list is Minda Corporation. Now, if you look at this stock, the entire auto ancillary got kind of re-rated, Sameer, this year, and we have seen stellar moves. This one, if you look at it for the full year, 142% returns already. What do you say?
So, if you see the results of this quarter, they have given a highest margin since last 12 to 15 quarters. That's around 11.5% on the EBITDA. Now, that is a positive. They are moving towards the electric vehicle movement which is happening. So they need to adapt before the actual OEMs adapt. So that's why the there'll be a faster movement on the EVM and the auto component space before the OEMs even take that call of shifting to properly. And they have around a 1200 crore order book. Out of that, 30% is into the driver information. So that is more of signaling and that is more of electronic already. And they've recently bought a firm called EI Labs that they bought at enterprise value of 6.5 crores. That is into electric vehicle components, designing and project space. So they won a order from EESL. So they've won a project already before they acquired it. So I think there is a kind of movement, but the amount of capex they are planning for the capacity expansions and already the heavy debt books they have, I think I would rather see more cash flow coming out of that firm before I take a call of being bullish and bearish on that.
Okay, but if you look at the valuation, the kind of re-rating it has seen, Amit, and now some analysts are actually already factoring in 30-35% kind of earnings growth for next 2 to 3 years. Is it too early to start counting on EV?
So what really happens is you start seeing 1 or 2 years of good performance in some of these companies, and you start extrapolating it for the several years into the future, assuming that this is now a sustainable thing. But especially when it comes to auto ancillary space, I wouldn't put too much focus on what are the projections going forward, for the simple reason that these companies have very little bargaining power. So if you look at the best auto ancillary companies in India or globally as well, the best would probably not be making more than 25% ROE on a sustainable basis. They might have years when they're making a little more than that, but the highest would be 25%. The normal would probably be less than 20%. So as a business model itself, they don't generate the same kind of ROEs which say some OEMs can generate, be it a Hero MotoCorp, Bajaj Auto or a Maruti, the kind of ROEs that they generate. So to ascribe valuation multiples which are significant premium compared to OEMs, that probably is not justified. And if what we are doing is just extrapolating the near-term earnings growth of these companies into the future and assuming that they will continue to have 30% kind of growth for a very long time, I think that's probably very high optimism, which probably is not justified by the business model.
So what's your call?
So I would be fairly bearish on this. It's a good company in the auto ancillary space. They have fantastic tie-ups, technological and good global partnerships. However, just the valuations are very in uncomfortable territory, I would say.
But Samir, I guess you are bullish.
I'm a little bullish. Taken into valuations, yes, they are high. But the only point which I see is since they have a good customer, everything is there. And there's more of volume growth which has happened in last 2 quarters. So that volume growth gives that there are certain new clients also added which are giving them the upside. So extrapolating is one thing, but the only point is how sustainable that growth is depends again on your client side. So if it has a certain part by the volume growth, then I'm most happy to give that kind of multiple right now, and maybe have a accumulation rather than buying all in right now. So that's my view from that side.
So accumulation is the better strategy over a period of time. That's the call coming in on Minda Corporation. Let's move on to the second stock of the day, that is JP Associates. Now this is more of a hope trade, I would say, Amit, isn't it?
Yeah, so what has happened in this entire bull run is first we saw the quality businesses getting significantly re-rated, be it in the consumer, financial services. Then we saw the second tier companies getting re-rated as well. And now we are really getting into the territory where even companies which are on the verge of bankruptcies, people are hoping that there will be a turnaround and it will create value. Now, in a week or so, we will get to know whether this will get admitted into NCLT and whether the insolvency proceedings will start. So for me as an equity holder to invest in this company is really pure speculation. I would ascribe very little fundamental value to it at this point of time, because equity might very well go to zero in the near future.
No, but if an RCom can resolve the debt issues, why not JP?
No, so I wouldn't compare RCom with JP Associates. One, RCom, the parentage has a lot of capital, so if they want, they can pay off a lot of the debt. JP Associates, I don't think the promoters have the kind of capital to ensure that the debt gets paid off completely. If that's not the case, then only the assets of the business will have to pay up for the debt, which looks unlikely. Most of the lenders will have to take a fair bit of haircut on the debt exposure, and if the lenders have to take a haircut on the debt exposure, imagine what's going to happen to the equity holders.
Okay, but this is one such a group, Samir, that has been serious about deleveraging from day one. They have been kind of trying to strike deals for a year or two right now, if you look at it.
So I don't have a particular view on JP Associates, but if I see the whole situation, see they've done with the cement plants which they've made. Now the only plus point they have is the JP Infra, which is there in the all the land bank which they have. See RCom also, if you see what they described as the deleveraging, there was a lot of land bank involved in that. So there's a lot of land bank sale which is going to happen. Now what price, what valuations, and when it happens is a whole different story. So same with JP, the only point is even if they deleverage, see the only way of deleveraging is selling off the assets. Now if you sell off the assets, the only thing is you come out of the IBC. But as a company you don't have any assets then. So why should as a equity investor have just an investment just because you will come from a IBC to a normal situation? I rather play a company which will have assets even after coming out through IBC or something like that, because their only asset is the land bank which they have, and if you sell off the land bank then you don't have any earnings point of view in that firm as such. So it's more of a speculative or a trading call rather than an investment call.
Okay, so even if there is no real write-off of equity as such, there won't be any value left maybe after the transaction.
If you've already sold your main businesses, then how will you earn out of? Where is the earning continuity in that business? So that is some question mark which I think should be there for all these IBC companies.
So JP is avoided.
Yeah.
And for you also?
Yeah, I would completely avoid it.
Completely avoid. That's the call coming in on JP Associates. Actually, it's almost impossible for a fundamental analyst to kind of figure out what kind of valuations should this company or the other group companies also be assigned. So JP is a complete avoid. Let's move on to the third stock on our list, that is all cargo logistics. Now what is interesting about logistics is we have been talking about it ever since the government started working on GST. And if you look at it, these stocks went up even before the GST was finalized, and they all corrected. Then GST got cleared. Stocks have moved a bit, here and there, but some of them are back to the prices that we've seen before. Some of them have not yet reached there.
Yeah.
What's really happening? What should one do?
So see, before GST bill was actually passed, there were a lot of speculations, and all these logistics companies went at least a 50-60% in the hope of getting the GST cleared. Once the GST got cleared, there was a e-way bill situation. See, for them, the main issue will be when the e-way bill from February gets implemented. Right now, what's happening, that e-way bill is not there. So
it's approved.
It's approved, but on the implementation side, it's not there. So they are having a free movement from every state. So that is giving every transporter a 40% increased capacity utilization, which is helping them on the numbers in past 2 quarters, let me say, in that sense.
So why just because you don't have to wait
because
for
you
inspection?
don't have to, so you don't have to wait everywhere, and it's more like the continuity and the stoppage time gets removed. So your truck is being utilized 40% more. So that gives that extra earning. Now, if the e-way bill gets implemented from the Feb, there will be a month or 1.5 months where the situation might get a little tricky, because over there the systems are different from what they are working right now.
Okay, no, but even then you won't have to stop at every checkpost, right?
No, you won't have to, but the only point is right now the e-way bill, the main issue is coming out that who'll raise the bill.
Okay.
So that implementation operationally is getting a little issued at the logistics issue.
No, but once goods are dispatched and bill is raised, after that this 40%
so
capacity utilization advantage remains, right? It
it should
change.
remain, but the only point is if that remains, then you have to have more trucks, right? Either see, if you don't increase your capacity, you will lose out market share. Then if you have to increase your capacity, you have to do a lot of capex. So right now what All Cargo is doing, they are planning to increase their warehouse capacity 3 times. So right now they have a 3 million square feet of warehousing capacity. They are planning to take it to 10 million in next 3 years. Right now they have a revenue of 6,500, and next 2020 they are planning around 12,000 crores. So that's doubling in next 3 years, or virtually now next 2 years. Now that is impossible organically from my point of view. So they'll have to do some wild, I don't want to call it a wild acquisition, but they have to do something which is beyond a certain logical levels. Because to double that kind of a growth immediately within 2 years, organically it's a very tough call. Otherwise you have to do very heavy capex just to get that aggressive growth. So that would deteriorate the numbers from my point of view.
Okay, then there could be balance sheet issue. But Amit, is the opportunity that big? Because if you look at the historical numbers, for 3 years they didn't grow at all. This year, now expectations, the reports that I have looked at, people are expecting a 10% growth. Same for next year.
So I do actually track All Cargo, so I will not probably comment on the company itself, but just on the opportunity, yes, the opportunity is there, because this is an area which is a large unorganized market. And once this e-way bill start coming into the picture, for the unorganized players, it starts becoming a little difficult, because they were just being cowboyish and going around with papers, just paying up small bribes at some places. This clearly helps the organized players, definitely. But remember,
everybody has to pay the right tax.
Yes.
And so therefore you think the organized players
yes,
will
so even companies will like to shift towards the organized players as to have them as the transporters. However, remember, All Cargo is not just a transport, it's not just a trucking company, it also has a lot of other pieces, which is the foreign logistics pieces as well. So I'm not sure how much this benefits All Cargo perspective, but yes, the opportunity is definitely there for all logistics players.
So what's your view on this stock?
So I'm neutral to it, but a little bearish till the time the system actually, because of the aggressive expansion they have.
You don't think they are in a
See,
position
I rather go to some company like there is a Snowman Logistics.
Okay.
Now they are focusing on cold storage. They have given up on the logistics business, so they are focusing on the cold storage. There is a VRL Logistics which focuses on only trucking majority of it. So I rather have exposures over there, because this kind of aggressive plan, I don't know what call they are taking and what mathematics internally they have to double in next 3 years. If they do, I might miss on the system, but the only point is I rather not risk it right now.
Okay, so that kind of explains, why if you are invested in one of the logistics stocks and wondering why you are not getting the kind of returns you want, I think this discussion must have answered most of your questions. Let's move on to the fourth stock in that case, that is Syndicate Bank. Now, this is a PSU bank, mid-size PSU bank, and I would say relatively better managed, maybe, Amit, because this is less than 10% or almost 10% gross NPA they had last quarter, and in last quarter it has come down a bit.
So no, including the stressed assets, it's gone above 10%.
Okay.
So
no, but when you have 20% plus,
yeah. So
block,
the way you have to look at Syndicate Bank, it's among the, I would say, less worse apple among a set of terrible assets.
Not as good as Indian though.
Yeah. So whether it's a good business or not, I don't think so. That's the case. It might be a better PSU bank. But the reason a lot of the investment thesis that is being built around PSU banks has to do with the valuations. So, for example, everyone's talking about, on the private sector side, you have companies like AU Small Finance Bank, which are trading at 8-9 times price to book, and you have a Syndicate Bank, which is trading at, 0.3 times or 0.4 times price to book. But in case of PSU banks, book means very little actually. The reason for that is the bad assets that sit on the books of these companies. A lot of them have still not been recognized. If they have been recognized, they have not been adequately provided for. So what can be a 0.3 times price to book can very well turn out to be 10 times price to book, because the book value can get completely wiped out. So as a policy, when we look at,
that's an extreme view to take, because
so it depends, so if there is a GNP of 11% and almost only the provisions are only around 30%, and the rest 70% still need to be provided for. And remember, this 11% we are talking about when you are still saying that a lot of the companies are still not being recognized as bad assets.
Okay.
And once those entire recognition starts happening, for example, RCOM will only now start getting recognized as a bad asset in companies'
this
books.
quarter.
That's a huge exposure. All PSU
but
banks
will come back in next quarter, I guess.
If it comes back. Again, we still, there's a long way to see on that front.
So I'll take it.
So when it comes to PSU banks, I'll be wary of just looking at it from a price to book perspective.
So what's your call?
So when we look at financial services, we focus a lot on investing in the best financial services company rather than the cheapest.
Okay.
We focus more on quality rather than valuations in terms of whether they are expensive or cheap.
So hold or sell?
So I would completely avoid all PSU banks pretty much, and the valuations only seem optically cheap.
Okay, you agree?
Somewhere yes, because see, right now, whatever, since the recap bonds were announced, so PSU banks have shown a little bit rally in their systems, just on the hope that
you think it's just a trading move?
Sorry.
You think this is just a trading move? And
it's not. See, some will come through out of it. It's not that the whole PSU bank system will fall out. There will be mergers, there will be consolidations, but the only point is now there's an extreme case of Vijaya Bank, right? That is one which we think will come out of the whole system when everyone goes into that recap and everything going down. If you think mathematically, see, it's around 7.4 lakh crore kind of a NPA sitting right now till last quarter. They've announced a recap bond of 2.1 lakh. So that will any which way go into provisioning. Okay. That has nothing to do with the growth of the banks. It's majority who grows out of that.
So once NPA is gone, you can probably find ways to really grow. But I think we're running short of time.
Yeah, so I'm a little negative on Syndicate.
Negative on Syndicate Bank. So PSU banks is not a segment that our experts like, but the industrial space that we have been talking about, and we had promised that we'll get picks from both our experts from this space before we wrap up. What's the stock idea that you have, Amit, in this space?
So on the long side, I actually don't have any good idea, especially for the reasons of valuations. So if you look at the valuations of the industrial stocks all of them are pretty much assuming that we are already in a very strong economic revival, as well as these companies are already seeing very strong earnings growth. The reality is we're still talking about economic revival being some time away. Even that's uncertain because we have been saying that now for almost 3 years pretty much. And when it comes to earnings growth as well, we are not seeing that kind of earnings growth when it comes to industrial stocks. However, one stock that we are fairly negative on is BHEL. For the simple reason that even if the economy revives, this company is facing significant structural challenges, which is low capacity utilizations in the power sector and a shift towards the renewable space that is happening. There is less investments that are happening on the coal-fired thermal power plants, and that means the order book for BHEL might keep declining going forward. And with a fixed cost structure, its earnings profile might be very weak going ahead.
So even if you had, you'll sell or you'll go short?
We are short actually BHEL.
Okay, you're short BHEL. Any stock that you like?
So I'm long called on the stock Gravita India. So now they're basically into recycling of lead. So they do a lot of recycling of scrap material which they buy from the market. So 80% is lead recycling. So they buy from all these home collectors, and they recycle the lead and sell it to Amaraja and Exide. That's the majority of it. They have done a 70 to 80% of capacity expansion, which will be completed in next year. So I see a lot of earning growth coming over there. So that is one space. Otherwise, industrials as a whole, there's no target which I give out on the stock because I like to see it quarterly and revise my stance quarterly.
Okay, so Gravita India is a stock in industrial space that Samir likes, and that is a short call from Amit on BHEL. And before we wrap up on the show, here is a quick recap of our experts' view on the stocks that we covered today. The picture doesn't look so that optimistic, at least on the stocks that we talked about in today's shows. With that, it's a wrap on today's Hot Money Ask PQ. Up next, stay tuned to Bloomberg Quint.